Hello and welcome to our April quarterly market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. So far this year, investors have been caught in a tug of war. If it were a tag team wrestling match, in one corner we have the crowd's favorite, Team Greed. On this team, there are a lot of positives: global economic growth, the stimulative effects of tax cuts, and estimated double-digit corporate earnings growth. But investors are worried about Team Greed's opponents. In the other corner are some formidable opponents, Team Fear. They're made up of the risks of an escalating trade war, rising rates, and above average valuations on assets. Personally, I think the growth potential of Team Greed can win out if investors rally behind them. However, we can't predict what happens with the tit-for-tat trade struggles between the US and China. If Mr. Tariffs gains momentum, it could tip the scales and give victory to the bad guys. Recall our theme coming into this year was making volatility great again. Now, how did we know? Well, 2017 was not normal by any measures. It was the lowest volatility on record. There was only one place for volatility to go, and that was up. Now, 2018 has not disappointed. Headlines matter again. Turnover and perceived turmoil in the Trump administration, rising rates, potential regulation of technology companies like Facebook, overseas worries from Russia, the Middle East, tariffs, and China. The list goes on and on. We've seen over 25 days where stock prices have closed 1% higher or lower than previous days' closing prices. There have already been two 5% pullbacks, but don't panic. As we've said before, pullbacks are normal. Shown here is a chart how often U.S. stocks pull back during a calendar year. Now press pause and read through the chart, and nothing we are seeing this year is out of the ordinary. 2, 3, 5, 1, and 10% pullbacks are not unusual. One other note is midterm elections are approaching, and historically, these add more volatility to the markets. In fact, the average correction during a midterm election year has been around 18%. We'll cover this more later this year. Investors have responded to the negative headlines, and fear has greed on the ropes right now. Investor sentiment has been registering at extreme fear levels. We haven't seen investors this worried since 2015. Taking a trip down memory lane, mid to 2015 was a completely different environment. China was slowing, energy prices were collapsing, European debt issues were front and center, corporations faced declining earnings, and it appeared the US was headed for recession. Yes, there are worries today, but nothing like back then. Global economic fundamentals are much healthier today. This is not 2015. Let's talk about trade and tariffs. So far this year, the Trump administration has announced tariffs on countries importing steel and aluminum to the U.S. and more tariffs on a list of goods from China. In turn, these countries have retaliated. If this escalates, it does risk derailing a lot of the positive fundamentals that we are seeing. Trade wars are not good. Tariffs are a tax. Prices rise, consumers pull back on purchases, economic growth slows, and people lose jobs. Confidence worsens and uncertainty grows. Investors do not like uncertainty. Then why did the U.S. enact tariffs? Some of it is political, but I believe most of it is a bargaining chip to use as leverage to improve trade for U.S. companies. Let's take a look at this chart from Michael Sembalest. Maybe when our politicians talk about bad deals, they are onto something. On the vertical axis is the average tariff applied by the U.S. to another country's goods, and on the horizontal axis is the average tariff applied to the U.S. For example, look at China in red. China, on average, socks U.S. companies with nearly a 11% tariff. Now, the U.S. only imposes a 4% tariff on Chinese goods. Is that fair? More importantly, when it comes to China, U.S. companies are tired of being ripped off. Per the 2017 IP Commission report, China is cited as the world's principal property rights infringer, responsible for up to $600 billion of annual losses to the U.S. economy from counterfeit goods, pirated software, and theft of trade secrets. The U.S. wants China to get tough on theft, and in addition, the U.S. wants China to level the playing field for U.S. companies wanting to do business in China. Hopefully, negotiations will be successful in resolving the tensions between the U.S. and trading partners like China versus a continuing escalation in a tit-for-tat manner. Let's switch gears and look at the fundamentals. It's not all that bad out there. Headlines have distracted investors from an environment that should be good for risk. There are a lot of positives. Economic growth, it's near 4% globally. In December, the IMF raised global growth estimates for both this year and next year. Europe and other developed markets are recovering from an on-again, off-again 10-year recession. Commodity prices have stabilized, and emerging markets are also seeing growth. Secondly, corporate earnings growth are continuing to show above average growth. To the right is the 12 months estimated earnings growth for U.S. companies in blue, international ones in red, and emerging market companies in green. MSCI estimates show double-digit earnings over the next 12 months globally, with emerging markets and international markets expected to post more than 20% growth in earnings. Here in the U.S., corporate tax cuts and repatriation leave companies flush with cash. Last year's tax changes are stimulative, and it's going to be highly unlikely to see a recession this year. Now, with this positive backdrop, how will investors respond? This is the million-dollar question. Corporate executives flush with cash certainly are trying to entice shareholders to remain invested. We've discussed in previous communications that we believe changes to the corporate tax rates and repatriation laws would encourage executives to reward shareholders via higher dividends, more share buybacks, and increasing mergers and acquisitions. Now let's see how this theme's playing out. Declared dividends hit a record high in the first quarter, according to S&P Global. This year we've seen a 5% rise in dividend payments based on their analysis. Barron's Magazine reports that based on preliminary announcements, there could be a 60% increase in stock buybacks from last year, and 2018 is shaping up to be the highest ever. And lastly, not to be outdone, mergers and acquisitions had their strongest start ever in the first quarter of this year, propelled by U.S. tax reform and faster economic growth in Europe, according to Seeking Alpha. Corporate executives are confident and pursuing shareholder-friendly actions. We believe this behavior will help support risky asset prices. Now, we're not saying stock prices have to go up, but we just don't see significant downside risk to these prices based on the fundamentals in the market right now. I also want to update you on international markets, as I continue to believe that they will outperform U.S. stocks over the next several years. Graphically, this picture highlights the differences between the performance of U.S. and international stocks. In gray is the U.S. stock market's performance. And notice over the past 10 years how much U.S. stocks have outperformed the purple line, which is international stocks. Now, this outperformance is for good reason, as U.S. corporate earnings growth has been much stronger. But, in my opinion, in mid-2016, the baton was passed from the U.S. to international markets to take the lead. However, many investors continue to ignore the opportunities in foreign markets. Also, notice the statistics in the box in the upper left part of the graph. International stocks are paying a 3.3% dividend yield. Now, this is pretty good in an environment where cash is still paying very low levels. The price-to-earnings ratio for international stocks is close to 10% below its 20-year average and nearly a 20% discount to that of US stocks. So, international stocks are relatively cheap. We also showed in an earlier slide that international stocks in emerging markets should exhibit higher earnings growth over the next 12 months, nearly double the levels of earnings growth that US companies offer. Prior communications covered our thesis on international stocks in a lot more detail, but I did want to keep this theme in front of you. Let's move on to an intermediate term risk. Shown here is the federal funds rate. On an intermediate to longer term basis, investors need to remember that interest rates are rising as the Fed slowly takes away the punch bowl. The Fed has announced 6 interest rate hikes over the past 2.5 years, with 2 or 3 more likely this year. Notice before each of the past 9 recessions, shown in gray, the Fed was raising rates. It's very likely the Fed will overdo it and tighten too much, and this will cause the next recession. Recessions are usually associated with pretty nasty bear markets for stocks. The Fed is also unwinding its balance sheet, and other central banks around the world are likely going to follow this year. Now, we do not believe this is a worry for 2018, but midnight will arrive in the future, and an investor does not want to be caught scrambling like Cinderella. There may not be a Prince Charming to rescue investors from the bear market that follows. Lastly, I will leave you with this chart. It's one we've shown you before. It's the Dalbar study, which compares the average investor's returns to those of other asset classes and diversified portfolios over the past 20 years. I think this chart's important as ever with all of the negative headlines out there. Don't let behavior or these headlines negatively impact your portfolios. Chasing yesterday's winners and letting fear and greed undermine your decision-making process may leave you like the average investor, far to the right and barely beating inflation. Instead, having a plan, investing based on your objectives, understanding risk and valuations, being diversified, and rebalancing will continue to help you as an investor survive volatile markets. I hope you enjoyed the current market update. If you have any questions, contact us at the number listed here. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update later this year. Thank you.